Before we begin, sir, if we may have a sneak peek into how did you get into this exciting world of investments that it's everybody is starry-eyed about. There have been movies made on it, and मतलब एक अलग दुनिया रहती है जिसमें कि at one point where people still consider it a gamble, and on the other hand, they are the rock stars of the देश, and जो कि they are running the country's businesses and growing our GDP. How did you get introduced to this world?
So you mean I got introduced as an investor, or you mean I got introduced as somebody who works in the space? Just to be clear, Vishu.
Kind of both, sir. Just your journey into the world of stock market.
So I guess it was way back. I don't think I started investing, but I got exposed far too early. Not as much in detail as I would like to, but I used to be somebody who stayed in a hostel while I was studying my engineering and my MBA post that, and we used to have inmates in hostel from multiple disciplines or multiple kind of degrees or education they were pursuing, and some of those people were also kind of either working in capital markets or, for that matter, interested in capital markets all the time. And you got interested by hearing some talks, getting exposed to it, generally developing interest in markets. So that happened with me way too early while I was still pursuing engineering. Just that I never got attracted to it as a profession. But right after my MBA, thanks to some exposure in terms of hearing about stock market, some bit about mutual funds. My first tryst with investing was actually via the ESS fund for tax saving purpose, where one of my friends actually, who was my roommate at that point of time, was working in a company where his job actually was about helping investors invest on behalf of his company. And maybe some bit of it was about he wanting to achieve some of the sales targets. Some bit was about his own concern about me wanting to maximize my tax savings. And that's where my first ever SIP happened in a fund house, which was taken over by some other fund house later. It was Fidelity Mutual Fund where I got exposed to it, and I bought a fund called Fidelity Tax Advantage Fund. So that was my first test with mutual funds. As far as stocks are concerned, somewhere once you start having some money and you start getting exposed to it, I think in the entire era from 2007 till 2008, 8ish, before the GFC global financial crisis happened, a lot of new investors got attracted to markets, and I was also one of them, where sometimes you were naive to get exposed to it and get attracted to make some quick buck. Sometimes it was also about investing in great businesses and getting exposed to it as an investor. And so it was a mix of both these things which got me into the markets. And from there on, I think I along with my co-founder in those days, Mukesh, who is now a CEO of ET Money as well. I personally got kind of stumbled upon some real life problems when the global financial crisis happened, where a lot of my investments in stocks per se, not necessarily mutual fund, uh, kind of corrected so much that not just my profits, but my principal got wiped out. And that's where a learning came in about investing is not as simple as just it sounds it to be. Identify good companies, or for that matter, identify good mutual funds, put some money and sleep tight. If you really want to make some long-term returns, you need some kind of approach to it based on your behaviors. And those episodes or lessons got us excited, Mukesh and myself, to build something unique in terms of helping investors succeed. And we've been kind of stuck along since then, since 2009 days, in multiple ways. And I think we are trying to do it a far better job in ET Money right now, where a lot of investors trust us, rely on our platform, make wise investing decisions. So it's a mix of all things come together, and I think we are pretty proud at ET Money in how we help investors invest in direct mutual funds, get advised if they wish to be via ET Money Genius, and of course, idea is that if you kind of manage your money really really well, a lot of people in the country can actually retire crorepati by far compared to what number of people are retiring today. So one learning has been that somewhere if you give time to investments, you actually can retire pretty, pretty rich. So that was keeps us motivated. Can we really get more people richer by following simple concepts of investing and not being carried away by the markets all the time, as most people tend to be? So multiple things coming together, and I think it's been a fascinating journey for me as personally as an investor as well as a professional.
Beautifully put, sir. You made a very interesting point in your while narrating your journey, sir, which was कि investing is not as simple as it looks. कि Nifty की 4 companies ढूंढो या कोई भी sector, pick up any sector that you want, and उसकी जो top 2 companies है उसमें आप करके अपना शुरू करो. You have to have a system, you have to have a philosophy that you live by, and कुछ एक system आपको पता होना चाहिए कि आंखें बंद करके नहीं invest करना है. So I would love to ask, what kind of investor are you, and what investing philosophy do you live by?
So I think we should everybody learns the way we learn on a job when we are a professional or employee in a company or running around businesses. We keep learning on a daily basis. So I think I've learned over a decade in how to kind of invest, may not be for success, but for maybe giving time. So I've seen multiple avatars where I used to be somebody who kind of dabbled in stocks and just blind SIPs when I started investing for the first time. I learned a lot in the global financial crisis corrections, and kind of maneuvered my own approach to investing in a different way, where I went about understanding, especially mutual funds, what exactly the fund is about, how does the fund, especially actively managed fund, runs its investment philosophy, what kind of differentiated investment approach it has compared to other funds in the category. And over a period of time, kind of get exposed to performance, cycles, underperformance, where you would take a step back and say there is some method to be needed beyond just understanding funds, because the fact of life is one is biased to study funds which are successful, which are winners of the recent past, and not necessarily which is a kind of a prediction of that fund's future performance. So nobody will go and analyze a 2-star fund or a 5 or a 3-star fund. People are typically interested, and I was no exception. I used to be interested in only the top performers and study them. And I think I learned the limitation of looking at past performance as a barometer of my filtering process and then studying them. And over a period of time, I moved to basically applying asset allocation to investments, where I figured out, I learned by experience, by reading, that it is no, it doesn't matter whether you are holding the best fund or worst fund when the market undergoes a sharp correction like a global financial crisis, or for that matter, in 2013, when the exchange rate kind of crisis came in, where rupee depreciates sharply, or for that matter, the mid-cap, small-cap correction in 2017-18 period, and then later in COVID, where the market corrected sharply. So if you look at correction phases of markets, when markets drop suddenly without giving you advance warning, and the correction continues for a while, it doesn't matter which fund you're holding in your pocket. Everyone goes down. And what makes money in those times for you is, are you diversified? And I think diversification, everybody talks, but very few people are able to practice with some kind of systemic process. And I learned kind of quite early in life that it's about asset allocation which defines your returns, and not the funds or asset class you're holding in. And it's simply because of one thing, that not all asset classes rise or fall together. So equity, gold, and debt, they behave differently. When there is a rally in market, they behave differently when market is in correction phase. And of course, they behave differently when interest rates or inflation are showing their adverse effects on the economy. So once you understand and try to really kind of build a portfolio of asset classes which actually are inversely correlated. When I say that inversely correlated, means that they're not supposed to, they're not something which where they rise together and fall together. That's where you actually get some stability in the portfolio. And my learning is, if you have stability in the portfolio when times are bad, you tend to stick around. And when you stick around, a time comes where the market is bottomed out and a rally follows, and you make money, far more money in that rally than you make money otherwise. Uh, if you, it all boils into one thing, that can you buy more time in the market? So from multiple versions that I have gone through as an investor, I've learned that the only thing matters is, are you able to give enough time to the market? And I think we have learned, read, listened from multiple people where it's not the timing, it's time in the market which makes money. And sounds very cliche, sounds very boring. But the fact of life is, even 8%, 7.5% PPF account over continuous 15-year period can make you very, very rich if you continue with the PPF account. So the lesson there is, it's not the rate of return which defines your kind of wealth creation in isolation. Is the rate of return and for how long you continue to earn that return. So I've learned that I'm somebody who is happy with 11, 12% CAGR on my portfolio for long period of time, then having an approach where I make 14 and then 18, sometimes 20, and then suddenly 5. That kind of volatility is something I can't digest as an investor as much as people might believe about me, given what I am as an investment professional. So I would rather prefer stability, and I think my philosophy has gravitated towards the thing that, can I buy time when I invest in this asset on this fund? If I can give time, I will invest. If I can't give time to that investment, I would not make an investment. So it's more about learning that compounding is a lot more there when there is time, and just pick and select investments where you can give time.
Hey, awesome, awesome. So now that we have covered your background and your investment philosophy, let's get to the meat of the matter that we're discussing today, which is practicing Warren Buffett's first two rules of investing in real life. So, would love to understand your interpretation of what Warren Buffett first says.
Yes, so I think everybody, at least I would like to believe that most people would have this amazing two rules that Warren Buffett talks about. Is rule number one, never lose money, and rule number two is, don't forget rule number one. Now, it sounds pretty impractical, to be honest, when you are investing in capital markets. Ultimately, it's not FDs we are investing in money and trying to follow this rule, because in FDs, at least in bank FDs, chances are very high that you will never have to follow this rule. It will be automatically applied in your behavior as well as your returns. But the fact is, when you're investing in capital markets, you will have to be open about continuous volatility and occasional sharp falls. And equities and volatility are like so closely attached to each other that this rule becomes impractical to follow in its truest sense. And I think one needs a modification to this to be actually practicing this in real life. So the practical application of this, in my opinion, is always fall less and don't forget rule number one. So if the rule gets modified to don't lose money, is losing money is inevitable. But can you fall less when market falls? So if you fall less when market falls, you tend to be somebody who will not take extreme reactions to it. and if you don't take extreme reactions, which mostly is panic selling or stopping SIPs, for that matter, uh, you tend to ride that wave probably longer than anybody else, the bad wave or the volatile wave. And if you come out of it, then your investments will give far better returns, is what we see time and again. So the practical application of that is, and I think it's also connects to human behavior. It's like uh, we are all wired to compare ourselves, our how we are doing as individuals, and how our close friend circle is doing as individuals, or our neighbors are doing as individuals, or for that matter colleagues are doing as individuals. So when there is blood on the street and you are having lesser wounds, you will always feel better about yourself compared to realizing yourself in a situation where the other people are at that point of time. And naturally, because you feel you are doing better compared to them, you will probably have a higher conviction to take along in that journey than what is the actual reaction, just give up. So if you modify this rule and say, let me practice falling less always, and never follow this rule, never forget this rule of falling less, you would probably see more success in investing than otherwise, is how I have personally experienced life as an investor. And this is what guides our principles of investing in ET Money. And this is what we possibly keep educating all the time, be it on Twitter or other social media, or making YouTube videos. So, and one of the ways is practice asset allocation when you invest. And if you make it dynamic based on market conditions, then you tend to get much more benefit out of this kind of rule number one, which is always fall less than otherwise.
Great, sir. Sir, you mentioned often traders or investors lose money when there's blood on the street. They get panicked, they book their losses and move out. Uh, I have a question. Do you think people, when they enter markets, when they're new, in fact, you also mentioned the SIPs, they stop SIPs and doing all of that wherever there's panic in the market, when they probably should be doing. Uh, I in fact read a statistic also somewhere. I think the 2020 में जो downfall में SIPs had started, barely 20% of them continue till date after 2 years. So that's very true, and it's actually supported. My question, sir, is: do you think is it lack of knowledge or experience or intellect about the markets that people suffer this, or is it purely based on psychology and you don't? What aspect do they need to work on? Do they need to read more about the markets, learn more about the markets, or do they need to build that psychology and work on that psychology over the market?
I think it depends on the kind of individual you are. So I wish there was one size fits all approach here. I think when you start as an investor, it is actually unfair to expect that you would indulge in reading more about markets all the time, take interest in how you should be investing better. So one tends to learn over a period of time. Some people learn, some people are very passive investors, and they may be doing well by being passive, or they may be suffering unknowingly by being passive. And if you take too much interest in the markets, daily movements, then possibly the reactions that we see at times of premature stoppage of SIPs or panic selling, they come into picture. So I think one needs to probably if the ideal approach would be take a step back and understand yourself as an investor. Not everybody can tolerate volatility. When I say volatility is ups and downs. So when I say that some people cannot even tolerate the continuous ups because they don't give time to their investments to really go and compound because they exit too early. And sometimes people are not able to tolerate the downside and they exit too early. So I think ups and downs, both are extremes. Ups and downs, both are pretty bad, ingredient to have in the portfolios all the time. So when you are somebody who's starting to invest or looking to start managing your investment better, being an existing investor, the first thing you need to do is you to understand yourselves. We have colleagues, we have neighbors, we have friends. Not everybody has same life situation. Everybody is different. Some people actually would want to work till 60 and even feel that one should not want to retire then. Some people would want to retire at 45. Some people would say that at 40, I'm too late to retire. I should have retired way back earlier. So I think everybody's different goals in life. Some people have different aspirations for their kids. Some people have different aspirations for what kind of home they want. So I think everybody is differently built. Uh, uh, but what is common is everybody has goals. We all have our own goals. Somebody's goals may be, having the best home, the best address. Somebody's goal may be the best education for the children. Somebody's goal may be actually retiring faster. Somebody's goal may be about having a lavish life. So everybody's built so differently, and surprisingly, what happens is everybody's investments are actually same. So if you open up the mutual fund industries assets under management breakup, you would see most retail investors actually invest only in equities, and most people actually have only same kind of flexi cap funds or mid and small cap funds. So one step back is like we are somebody's engineer, somebody's marketer, somebody's a doctor, somebody's a lawyer. And all of these people have different goals and aspirations, but our investments are same. I think that's where the first problem happens as investor. We need to understand that because we are so built differently, our financial conditions are different, aspirations different. We need to be differently managing our investments. So first thing is understand yourself. The first step of understanding is actually doing risk assessment and understand what kind of losses you can tolerate. It is very easy to say that, I'm going to be a long-term investor. I would continue investing for next 15 years, come, whatever situation the market may be, whatever economic condition may be, I will stay invested for 15 years and continue SIP. It is very, very easy, and hence it's very easy to say, but as you said, most people stop SIPs pretty fast. Is because we become impatient, because when we invest with a 15, 20, 25% CAGR expectations. And when we don't see our money moving, we give up. So if you understand yourself that you are not an aggressive investor, you would possibly go and search for an option which is not suited for kind of, an investor. You always search for an option which is suitable to you. And if you are somebody who's a moderate investor, you would go and hunt for a balanced advantage fund or a balanced fund or a multi-asset kind of fund where you basically are getting some kind of expectation that you may not be rising every day as your portfolio starts to get deployed, but you will not be falling like a knife as well. So if you are somebody as a moderate investor, you need to have investments which are moderately risky. If you are an aggressive investor, you would typically kind of tend to see that you are not happy with returns and a slow movement of money, and you would want to see more excitement. So you would need to really find an investment which is best suitable to you. So I think if you find investment which are suitable to you, you would tend to give more time to them because you have the expectation set in yourself, and that is expectation when you realize in real life. Your conviction to stay invested becomes stronger, and the time that you give in the market becomes higher. So, and ultimately, which is what defines returns. So, if you just do one thing, is understanding what you are as a person, what your goals are, it is a first step to really go about and build a good portfolio.
Right. Awesome. Awesome. On a related note, sir, what you mentioned, talking about the first steps of building your own portfolio, you get to hear a lot of stories when you're just entering the market. You get to hear a lot of stories. So there'll be your uncle will hear this company is good. I made these many returns. There'll be a friend who will tell you something else. There'll be news on TV. They'll be telling you something every day. There are 1,000 people saying everything about everything. So it's said that you should not chase all of that, the glitter, and instead you should focus on what you know. Maybe say it may be if you belong to a particular industry, stick with that. Usi mein hi aap invest karo. It may be you have identified a system that will stick to that and ignore all of that as noise. Would love to understand your opinion on that.
Yes, so I think, when it comes to investments, as I said, we all get attracted to the recent returns and actually forget that what has happened to in the distant past with respect to the return. For example, if you just take a simple, most popular stock in the country, maybe Reliance Industries, and if you look at the history of Reliance Industries as a price chart, you would notice that from 2009 till even like 2016. I think 2016 is when they announced Jio, somewhere around that point of time. The stock barely moved. It was a period of 7 years of no return. And suddenly when you look at Reliance today, and it has given it has been like almost a 3x bagger in last 3 years, despite the correction in the market right now. Uh, Everybody would feel that this is the stock of the future and I should be investing. But the moment you come and talk to the person and make the person understand that, yeah, it may be possible, who knows? But you should not be investing all your money there in one stock simply because it has a period of 7 years of no return in between. And maybe something like similar that as well before that as well, which I may not be able to look up and explain about it. But for 7 years of no return or 8 years of no return, would you be somebody if you invest today and if return doesn't follow for 8 years, would you hold that stock for that long? And it may happen that only after you sell the stock again gives a 3x back. So what happens when we tend to get attracted to the new shiny toys of investments in the marketplace? We tend to forget that a volatile investment, by definition, can have long periods of underperformance and very short periods of extreme rallies. Or something can be as consistent as an HDFC Bank, for that matter, which has grown at a very good CAGR for a long time to come. So nobody can predict how a stock will move. Similarly, nobody can predict how a mutual fund will move. But because mutual funds, by definition, are diversified, a pool of investments in a specific asset class or multiple asset classes, you at least are getting diversification. So it will be hard to find that a mutual fund has not mutual fund, because by definition it will be benchmarking against a Nifty index or a mid cap index or small cap index. It may give underperformance compared to the index, but it will at least kind of mimic on the way up or the way down some movement of that index, because it is diversified across set of stocks or set of asset classes. So we should appreciate that if one only looks at short-term recent performance to decide for or against investing in an asset class or an investment instrument, we may be up for a surprise in what follows after our investments. So understanding what you're investing is extremely important. And by definition, diversification is the only place which saves you in terms of helping you give more time. So it's very easy for me to say this advice that don't get attracted to something which is new, glitter in the marketplace. Most people will get attracted. But having an investment plan in the back of the mind, because you know your goals, you require money in 10 years or 5 years or 15 years. You know what kind of person you are, whether you can tolerate ups and downs. You would know, would you stick around? At least you can estimate whether you can stick around when the market falls by 50%. Having answers to these questions will automatically play some role to help you make a right investment. And if you do that, that's where I think investing success gets determined. Otherwise, it may be luck of the market situation which may determine your outcome, and only leaving to the markets movements your investing future is something which is possibly not the best way to go about investing your hard-earned money.
Right. Awesome. Okay. So now that we have covered the what, my next question is when. The question is on timing the market versus time in the market. So So there are so many fundamentals and there are so many philosophies. Buy it, there is buy at any prices, buy low, sell high. Uh, is it possible for a retail investor to actually time the market, or you have to enter whenever you can? And can there be a philosophy or a science around it?
So, I think everybody as investor secretly wants to time the bottom when he or she is investing and putting money, and would want to time the exit when the market is at the highest levels. But doing once or twice may actually happen to a set of investors. I would actually term it as being lucky than actually doing it on purpose. Very few people can get that every time right. So even experts can't do that, in my opinion. So
This space was downloaded via spacesdown.com. Visit to download your spaces today.
having retail investors attempt that is, in my opinion, quite far off. But one cannot stop the human urge, in my opinion, to time market. However, if one develops some ways to determine how one should be investing, uh, uh, one may unknowingly or methodically can time their entry and exit more right often than wrong. So I would not term that method as timing, but as investing framework. So let's take an example. It's like if you say that one makes more money by buying low and selling high, that's one way of investing. But there can be other frame of investing as well, which is momentum investing, where one would say that buy high, sell higher, right? So both require very, very different approaches, and one needs to know what kind of approach would suit oneself. So, and the third piece, in my opinion, can be that can I apply some dynamic asset allocation principle? So when you're saying buy low, sell high, or buy high, sell higher, they can be applied pretty nicely to stocks if you know how to value, or can be applied to, say, an index-based investing primarily by having some framework. But if you really want to do it in a diversified way, because the fact of life is doing it consistently is difficult, but doing it consistently across multiple asset classes can give you more benefit, simply because when equity goes down, gold may go up, or when equity doesn't give you return, that may come as a savior to you. So the third principle, which is I'm a big fan of, is the practicing dynamic asset allocation strategy in your portfolio, wherein you basically not just look at one metric or one asset class like equity or one metric of valuation. You look at multiple things together. And we do that at ET Money and ET Money Genius. I would avoid talking about that aspect, but maybe look at some example there. It's like, can I look at history will tell you that when interest rates start to fall to a level that the common man feels that it is far more better to spend this money than keep this money in his bank account. That means the interest rates are so low that one wants to possibly either gamble that money into something more productive, or probably go and spend that money in bettering one's lifestyle. So time and again, when interest rates fall to a bottom, that's where equity markets start to give you better return. It has happened multiple times in the past. It has also happened in a way that whenever markets are actually flush with liquidity, you can take an example of demonetization. When demonetization happened, a lot of money came in the markets. It recently, in fact, while nobody can claim that it is because when the 2000 crore rupee notes got withdrawn from the market, somewhere around that, the rally in the market started. So I'm not saying, and I'm giving the credit to those two events, but the fact is, when the money moves out of bank accounts, it has a reason to move. And most often that is actually either some external movement or interest is being too low. Now, you cannot predict those demonetization or external events, but you can actually understand interests are very low in the marketplace. And the real rates that one is getting post-inflation is far lower. So that's where equities becomes attractive sometimes. Uh, there can be other issue. There is another rally for continuous 2-year period, and markets have almost nearly doubled as we saw in 2021. If you compare to the base the market formed in March 2020 and the levels that market achieved in October 2021, it was almost like a more than 120 or 130% return, maybe 150% return on Nifty. And uh, 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 everybody was probably talking and across the marketplace that markets are expensive, they're overvalued, but retail investors actually put most money in 2021 and not in 2020. So there is another view that you can have a look and understand that markets are expensive. So is there a way to understand that markets are cheaper or markets are expensive? And is there a way to understand that, there is a pattern where how gold moves in times of uncertainty. You can't predict times of uncertainty, but can you predict that inflation is way too high and typically is there? That's where gold starts to perform, and probably gold starts to perform as well when interests are too low as well. So if one develops some patterns and understands that if one is able to manage one's allocation into equity, debt, and gold with some kind of investing principles and framework, chances are very high that you would possibly end up buying the lows. Chances are very high you'll be end up exiting at least some of your money at the highs, and maybe able to get some exposure to gold unknowingly, knowingly, because you follow some investing frameworks. So personally speaking, I'm a fan of that kind of approach, and I practice it in my own portfolio. It requires access to data. It requires access to understanding of these multiple asset classes. It also requires understanding of some kind of how the government, RBI, central bank, developing markets are behaving. If you don't have if you can't get that view, there are ways to practice this approach in investing via a different kind of categories of fund like multi-asset funds or balance advantage funds as a category. Or you can also have an investment advisor for yourself where that individual or your manager can help you maneuver this thing a bit better. So instead of going and saying that I want to time the market, if you end up having some principle or framework to invest, chances are very high that you will end up buying the low, selling the high, or buying the high and selling the higher. And automatically, you end up doing things which we all believe ends up making more money. But more importantly, when you practice this, you tend to fall less and end up practicing the rule number one we talked about earlier, which is always fall less. If you fall less, you will give more time. If you give more time, you'll end up accumulating more SIP value or keep investing more time, more value in the markets. And eventually, as I mentioned, that in 8% CAGR over a 20-year period can give you good returns. Similarly, if you elongate your time to market and if you end up earning 12, 13% return, 11% return, you will be seriously wealthy after 20, 25 years in your life. So it's all about what kind of person I am, and can I really follow this boring way to invest? When I say boring, it means that I'm just following somebody because one is a fund manager in a multi-asset fund category or a balance advantage fund, or I'm following an advisor. I'm not applying too much of my own intellect there. But I would rather prefer that approach of boredom to make money than actually trying to burn my fingers in trying to guess the next move market.
Right. Brilliantly put, sir. One of the main central themes of this discussion that we are having, time and again, I think we are discussing, you have to understand yourself as an investor and then take the right approach there. I think in understanding oneself, one of the most difficult things to do is understanding your risk appetite. So if I ask someone, are you ready? Okay, you're going to invest. Are you ready to lose 10% here? They may say yes, but then when they see those red figures, they don't really understand. Our brain probably doesn't comprehend what does 10% mean for us in when it comes to real life. How can one practically assess their risk appetite?
Yes, so there is no I doubt that we, as an investor, you would know beforehand, before suffering some kind of fate in the marketplace, be it on the upside or downside, to discover that. But if you want to avoid that learning by experience, there can be some kind of special tools available to you to kind of, at least judge or directionally judge your risk appetite. We do that at eMoney, and we call it investor personality. So it's a tool available completely free to users of ET Money, and they can assess themselves. So what happens is the tool can guide you or kind of throw in output for you, which can resemble what kind of behavior you exhibit or you're likely to exhibit when you invest in markets or in any kind of asset class. So if you understand that, that becomes a first step. But I wouldn't really know how to do it of go about understanding yourself, except these two methods where either get experience of a few years in the markets by making or losing some money. And I think losing money teaches you far more than just making money. I think a lot of lessons that I have personally learned is by losing money. And I don't call them a loss, I call them learning. Or you take a help of a tool like in ED Money, where we invested personality. At least it will be a good starting point for you to understand what kind of person you are. So just for the kind of, for the sake of giving more kind of understanding of how the tool works. So depending on what kind of tools any app or any investment advisor or a wealth manager may have, at ED Money, we have this thing where we assess you on three broad parameters. Number one being your aversion to losses. Which means that how badly your investment plans change when there is slight volatility in the marketplace. So if you're somebody who is compelled kind of in your behavior to make some fast extreme changes just to satisfy yourself that you're doing something to prevent that loss, that means your aversion to loss is very high. And making change to long-term investment plans because of volatility is the first sign of you may not be achieving your investment outcome that you are wanting for yourself. So that's number one, average losses. Second piece that we judge is how kind of level of confidence you exhibit while you take decisions. So are you somebody who's overconfident about yourself when you take a decision or research something and you know that you've got it all right, there is no way you'll go wrong? Or are you somebody who's open to kind of changing one's approach if one comes across a new data point and show some corrective behavior, which is a positive one? So level of overconfidence, if it is high, it is something which showing you that you might be taking more aggressive bets than you are supposed to do. And third piece is basically understanding level of financial intelligence you have. It's just basically how much kind of well read or having some basic understanding of financial markets, personal finance in general you have as an investor. Once we get these three levels for yourself, which is aversion to loss, financial mastery, and level of overconfidence, we basically convert this into a score, which is dynamic risk range, which is like, are you somebody on a scale of 100 who exhibits 60 to 80 kind of score all the time? Or you're somebody who is exhibiting a score of 75 to 95 all the time? Which means that if you're 60 to 80, it means that for short-term goals, you'll possibly be taking a more moderately risky approach. But for long-term goals, you will exhibit an aggressive outlook towards investment, which is indicated by a score of 80. But if somebody is 55 to 65, that means that be it short-term goals or long-term goals, you're somebody who just hates volatility and would always prioritize stability over lopsided, ups and down movements in the marketplace, which can give you very good returns, but sometimes can give you very bad returns as well. And it's not about judging oneself that, one is 55 to 65, so one may not be able to create wealth. That's not a right way to conclude. It's all about go in and build an investing strategy which can give you what you desire from your investment, which is stability. Go and build a portfolio for yourself which you desire as an outcome, which is good long-term wealth creation and you being open about ups and downs. So once you understand that piece, building a portfolio can actually be not very difficult if you are somebody who's wired to look for diversified funds across multiple asset classes, like an aggressive hybrid fund, a balanced advantage fund, a multi-asset fund, or go and hire an investment advisor like an ET Money Genius, which can help you construct a good multi-asset strategy of investment for yourself.
Right. Awesome. Awesome. Okay. Coming to a slightly more, narrowing it down, talking about mutual funds in particular, as an investment choice. Can you tell us maybe the top three things that people tend to miss when they go about deciding their mutual funds? Because there are articles and everything that you should look at this, and EHs or HA, but what are the most common things that are missed is what I want to understand. They are very important that we should take care
of. I think there can be many, but if I were to look at top three, maybe the way I would go about answering that question is, first of all, don't make, that you should be knowing what you're investing in, number one. Once you know what you are, that's my assumption here. You should be knowing what you're investing. Are you investing in a full equity fund? Are you investing in a strategy which is a full mid-cap fund, or are you investing in a flexi-cap fund? Understanding what kind of underlying investments are going to be in that fund, I think is a basic duty that you're supposed to perform as an investor, given that it's your own hard-earned money. The second piece is knowing, do you have an exit plan? Typically what happens is we invest and we keep investing till the time we realize that I need to take money out. And taking money out is sometimes or more often is not your own choice alone, because markets may behave in a way where you, despite wanting to take money out, may not be able to take the money out because you are suffering losses, and nobody likes to book a loss as an investor. So having an exit plan is important, and depending on the fund category you're investing, you would need to have a minimum tenure investment and an exit plan after that. So if you're investing in a mid-cap fund, data will tell you that there can be long periods of underperformance, volatility, and typically if you're investing horizon is 7 years or 6 to 8 years kind of range, there's a very, very high chance that you would end up making a decent positive return for the risk you're taking. If you're a large cap fund, maybe it will be 5 to 6 years. If it is a debt fund, it may be requiring at least 1 to 2 years of investment horizon to be able to have a positive outcome for your investment. So, understanding what category you're investing will automatically help you arrive at the right investing duration for yourself. And third piece, which you should be keeping in mind, is what kind of amount you should be investing in that fund/investment vehicle. Simply because most people have this random approach to deciding investment amount based on the savings they're having. So somebody will say, let me start with 5,000 rupees and I will continue 5,000 for maybe next few years, without realizing that my affordability was actually 10,000. I just started to taste the category by putting 5,000 rupees, but I forgot in my daily life that I needed to invest 10,000 rupees. So actually understanding what kind of position size, what kind of exposure you need to have to be able to make a meaningful return in absolute terms. Because if you invested 2,000 rupees in SIP and the money grows at a 12% CAGR after a few years, it may not be enough to help you achieve something meaningful in life. But the moment you put a larger bet size, if you can afford to do that, then a 12% can return over a 7-year period can transfer into some meaningful number for you. So I think, there is a simple calculation. If you invest 15,000 rupees, earn 12% return CAGR, and you continue investing for 20 years, you will have 1 crore. Yeah. So, but the fact is everybody wants to get to 1 crore without realizing that you require 15,000 rupees minimum per month on a 12% return vehicle and need to give 20 years to be able to reach the crorepati status. So understanding that piece of how much you should be investing is third most important point, I would say. So once you understand yourself, kind of be sure what kind of category you're investing in, what kind of investment horizon it will require, and third piece, what kind of amount you should be investing in. And the assumption is you actually will go and pick the investment category which suits you.
Right. Perfect. Sir, my next question is more around the second point that you covered, your horizon that you have to understand. Can investing, it's a two-folded question. One is, can investing be short term, which people also call trading in one sense, but I'm talking about investing in not trading per se, where you get into some technical action or anything. Even in mutual funds, can you invest in short term, maybe in mutual funds? Or is it only long term? And some piece of advice for if it is possible, then how can one do so? Some advice to them.
Yeah, so I think pretty much possible. I think mutual fund, at least mutual fund as a product has categories which are suitable for a few days of investment to few years to even like a decade plus investment kind of tenure. So it is pretty much possible to invest for a extreme short term, medium term, long term. And we can even delve deeper into these pieces, but to answer in simple language, yes, it is possible to invest for short term, though that typically when we invest, we would always are wired to think like a good return. And for most people, a good return is, and for me, good return is anything which is basically earning like 9 to 12% return as well. Of course, I would always want to earn 12% plus, but for most people, believing that 15-20% is a good return is a second nature, which I think most times is misplaced. You can aim for it, you can wish for it, but you may not get it is what you need to be open about. So I think using the term investment for a few days will lead to disappointment simply because associating the word investment will make you expect more. So when you invest for a few days in a mutual fund, you would be asked or recommended that stick around to liquid overnight funds. If you invest for a few months, people might tell you that stick around liquid or ultra short term investment kind of categories. If you will say that I want to invest for a 1 or 2 years, people may recommend you short term debt category. And these are back of the envelope thumb rules. I'm not saying that it is a gold gospel truth that you should go and follow. But on a rule of thumb basis, these are categories which may make sense. But then the moment you are having investment duration of as short as a few days to as at max as 1 year, you need to have set your expectations right by putting money for this short duration. You're mostly parking it for some kind of savings account plus return and not necessarily creating long-term wealth. So as long as you know that the return expectation should be mellowed down based on the duration of investment, you would not go wrong in choosing the category which basically is suitable for the duration.
Right. Awesome. Great. The next question is around portfolio rebalancing and when and how to do it.
So I think when you're kind of practicing asset allocation, the only way you can succeed at investing via asset allocation plan is by practicing asset rebalancing as well. So depending on what kind of asset allocation strategy you're deploying for your investment, it will determine what kind of asset rebalancing approach you should have. So I will probably try to answer this with an example here. So if you're somebody who's practicing, say, a static asset allocation strategy, which is very simple, like 50-50 equity and debt component, or like say 60-30-10, 16 equities, 30 in debt, 10 in gold. Let's for the sake of example. So this is static asset allocation approach that you kind of apply to investment probably can work really, really well over a long period of time for most investors. Uh, uh, Over here, you need to keep an eye on your portfolio in a way that if you put money, like out of 100 rupees, you put 16 equities, uh, the moment you have to define threshold that the moment, for example, the 60 becomes 65 because of market movements, I would trigger a rebalance. Or for that, when the moment 60 becomes 55 because of market correction, I would trigger a rebalance. So in the former, where the money of equities becomes 60 to 65, you need to book that 5 rupees profit and redeploy into debt or gold, whichever has kind of, the room to absorb that thing. So for example, if 60 has become 66 or 65 and the money has remained constant, that means gold and debt have depreciated, which is typically not possible. But for the sake of example, I'm taking this right now. If the money has remained constant as 100, money 60 is appreciated. That means either debt and gold would have suffered a 20% loss, uh, or because 15% loss. So you need to take that 5 rupees out and put in to debt or gold to make them come back to a position where they are the net result after putting that 5 rupees back into money would be 60, 30, and 10. If you are following 16 equities, 13 gold, and 13 debt and 10 in gold. So ensure that the ratio of equity, debt, and gold remains constant after redeploy the 5 rupees that you take out from equity. Similarly, when if it is followed 55, that means you will take money out from kind of, debt or gold or both of them to make the desired allocation of 60, 30, and 10 come back alive. So it is one of the most simplistic way to practice asset rebalancing. And you may set a frequency that I will review this once in 3 months, once in 6 months, or maybe once in a year as well. And there's no right or wrong in this, to be honest. There is no way. Market situation may prove in hindsight that reviewing every 3 months was good or not. And it should not matter, because when you're practicing a 60, 30, 10 asset allocation for yourself, you typically are going to be doing that for a long period of time. And over a period of time, it might even out the aberrations that you may see in sometimes short terms. The other way to do this is basically practicing dynamic asset allocation. So if you're somebody who is not having any kind of, preconceived number in mind that I would put so much in equity, so much in debt, so much in gold, I might be zero in gold sometimes and have a predominant equity and debt portfolio. But when I'm practicing dynamic asset allocation, then some kind of investing framework will come into picture, which will require access to data. So you might have a bearing on your equity allocation based on interest rate movements. You may have an allocation towards gold based on inflation and interest rates together. You may have allocation impact on debt, simply because there is a runaway rally in the markets and there are indicators which are telling you market is overheated. So if you apply dynamic asset allocation, you then rebalancing frequency ideally should become more frequent, or depending on triggers. So for the sake of being simple, we recommend like review your portfolio once in 1 month or once in 3 months, depending on what kind of investor you are. And depending on what the modeling that you may have done or a plan that is showing to you, and what is deviated from that at that point of time, practice the way to get it back to the ideal allocations. For example, if we were to look at October 2021, the dynamic asset allocation principle may have told you that you're practicing a 55 in equity, and 45% in debt. For the sake of example, I'm putting it right now. And come February 2025, when the Russia-Ukraine war happened, you may have actually added gold to it, because some investing framework would have told you that you need to add gold to your portfolio. So the 55-45 may change to something else. And again, when the market corrected sharply because of the Russia-Ukraine war, you may have increased asset allocation towards equity from 55 to something else. So when you practice dynamic asset allocation, by definition, even rebalancing will be dynamic in nature. So depending on what you are following, you would need to do that. In my opinion, most investors may not be able to kind of, apply dynamic asset allocation as a practice or rebalancing as a practice without availability of data to themselves, or for that matter, having a investment advisor available to themselves at the service, maybe like the ET Money Genius or an offline advisor. So it depends. Your rebalancing will be defined by what kind of asset allocation strategy you're following.
Right. Awesome. Awesome. This has been a very insightful session, sir. But all good things come to an end, and of course, you have taken so much of your time already. I have two requests. One, first, please do allow us to host you again and learn more from you. And second is, before we end the session for tonight, please do give a final concluding advice that kind of sums up it all, and we must always bear in mind.
Sure. I would try to kind of put a very simple framework to this, and if I'm going to apply, maybe most people will see better approach to investing, and it applies to not really picking stocks. It applies to how to build a portfolio. So I think the first principle that one should practice in life is remember the rule number one of investing is always fall less. We tend to overestimate our capability to stay invested in volatile markets buy when markets are falling, and we also kind of underestimate sometimes the financial conditions which may change when markets are bad, and both of them coming together can destroy your resolve to stay invested. So apply this principle of always falling less. When you apply this principle, you will tend to do more diversified investments. Second is, figure out a way that you are able to give more time to market as well. So that means you need to have instruments which actually have stability in your portfolio in long period of time. Third piece is, don't make the mistake of taking excessive risk on small portion of money while keeping large portion of money in extremely safer assets. So in my experience, I see a lot of investors who actually have an SIP of just like 5,000 rupees or a few thousand rupees per month, but large portion of their savings, maybe 3x, 4x of that size, 15, 20, 25,000 rupees, they save every month from the monthly income, being salaried, being self-employed, and that lies in bank accounts or bank FDs. So in the process, what you're doing, you basically are having large portion of your money, maybe about 80% of your money, into safer assets earning 6%. But the small money you would go and put in a small cap fund or a crypto asset, or in some kind of extremely risky strategy where even if that money becomes a multiple and multiplies by 3x, 4x, the net impact in your wealth, because a large portion of money is lying in safer assets and earning just 6%, the net impact in your portfolio will not be much. So basically take moderate risk, reasonable risk on larger portion of your money, and not do the reverse that we talked about. And fourth piece is, just don't have a view about markets. Like, the markets are not servant to anybody's opinion. Nobody would have expected how the market fell in 2020. Even if there was lockdowns getting announced in the third week of March or second week of March, nobody would have predicted that the market will keep falling 5% every day. And nobody would have expected the rally which followed after March 23. Again, similarly, nobody would have expected that markets will remain resilient in the face of, the US Fed while US Fed keeps increasing interest rates in every monetary policy review at their end. And similarly, nobody would have expected that India will make a bottom in March and suddenly have a one-way rally of 15-20% in a matter of few weeks or months. So nobody can have a permanent view on the markets. And the moment you fall prey to having view on the markets, you would tend to basically become short-sighted in investment decisions. You may want to take advantage of entry point. You may want to take advantage of exit point. But the moment you have a principle of investing with some kind of asset allocation, diversification, portfolio build-up approach, then you would not tend to have opinion on markets, but you start respecting data. So these 3 or 4 things, if you do it rightly, chances are very high that you would make money. Maybe last bit I can add. Most people in India actually tend to not get opportunity to book profits. So or rather, we miss booking profits when markets are high, and similarly, the way we miss investing when markets are low. What doesn't hurt is investing low, but what hurts more is missing the opportunity to book profits when markets are overheated. Only you realize the market's corrected 15-20%, and then you almost wiped out all your profits. So people should not shy away from booking profits. I think in this approach of sometimes when we read Warren Buffett and all everybody, and that's a great way to follow investment. Having a super long-term horizon when they're sitting on decent gains in life, you should book profits. And if you're practicing asset rebalancing, booking profits becomes automatic in your life, because the way we covered the example of if you start 60-40 and markets jump up to a level that you 60 becomes 65, take that profit off and go back to 60. It basically builds a methodical way to book profits and book losses and buy low and sell high, which is the ultimate way where you create wealth. So ultimately have some kind of investing framework which can govern all these behaviors for yourself automatically instead of trying to inculcate yourself some outside impulses.
Amazing, sir. This was an awesome session. We have some questions, but unfortunately, we are out of time. Mere questions and itna time de liya. We'll try to get Santosh sir again and ask many more questions from him. For now, this is it. Thank you so much once again for taking out time for us, sir. And please do allow us to host this again. Would love to learn so much more from you.
Thank
This was
you.
it.
Yeah. So thanks for having me here. I had a great time and engaging with you here. Thank you for having me again.
The pleasure was all ours, sir. Thank you so much, everyone, for joining in. We'll be back like usually on Monday onwards, Market Kya Lagta Hai series, and of course with more guests to learn more about investing and soft markets. Thank you so much for everyone. Have a green portfolios in the coming months and years. Bye bye. Good night.
Thank you.